A conglomerate is a multi-industry company, i.e., a combination of multiple business entities operating in entirely different industries under one corporate group, usually involving a parent company and many subsidiaries. Conglomerates are always large and multinational, often labeled a trading company, shipbuilding, and both production and trade of East Indian spices, Indonesian coffee, Formosan sugarcane, and South African wine. During the 1960s, the United States was caught up in a conglomerate fad, which turned out to be a form of speculative mania, due to a combination of low interest rates and a repeating bear bull market. Conglomerates were able to buy smaller companies in leveraged buyouts. Famous examples from the 1960s include LinkTemco Watt, ITT Corporation, Litton Industries, Textron, and Teledyne. The trick was to look for acquisition targets with solid earnings and much lower price earnings ratios than the acquirer. The conglomerate would make a tender offer to the target's shareholders at a princely premium to the target's current stock price. Upon obtaining shareholder approval, the conglomerate usually settled the transaction in something other than cash, like debentures, bonds, warrants, or convertible debentures. The conglomerate would then add the target's earnings to its own earnings, thereby increasing the conglomerate's overall earnings per share. In finance jargon, the transaction was accretive to earnings. The relatively lax accounting standards of the time meant that accountants were often able to get away with creative mathematics in calculating the conglomerate's post-acquisition consolidated earnings numbers. In turn, the price of the conglomerate's own stock would go up, thereby re-establishing its previous price-earnings ratio, and then it could repeat the whole process again with a new target. In plain English, conglomerates were using rapid acquisitions to create the illusion of rapid growth. In 1968, the peak year of the conglomerate fad, U.S. corporations completed a record number of mergers, approximately 4,500. In that year, at least 26 of the country's 500 largest corporations were acquired, of which 12 had assets in excess of $250 million. All this clever financial engineering had very real consequences for people who worked for companies that were either acquired by conglomerates or were seen as likely to be acquired by them. Acquisitions were a disorienting and demoralizing experience for executives at acquired companies. Those who were not immediately laid off found themselves at the mercy of the conglomerates' executives in some other distant city. Most conglomerates' headquarters were located on the West Coast or East Coast, while many of their acquisitions were located in the country's interior. Many interior cities were devastated by repeatedly losing headquarters of corporations to mergers, in which independent ventures were reduced to subsidiaries of conglomerates based in New York or Los Angeles. Pittsburgh, for example, lost about a dozen. The terror instilled by the mere prospect of such harsh consequences for executives in their home cities meant that fending off takeovers, real or imagined, was a constant distraction for executives at all corporations seen as choice acquisition targets. During this era, the chain reaction of rapid growth through acquisitions could not last forever. When interest rates rose to offset rising inflation, conglomerate profits began to fall. The beginning of the end came in January 1968, when Litton shocked Wall Street by announcing a quarterly profit of only 21 cents per share, versus 63 cents for the previous year's quarter. It would take 2 more years before it was clear that the conglomerate fad was on its way out. The stock market eventually figured out that the conglomerates' bloated and inefficient businesses were as cyclical as any others. Indeed, it was that cyclical nature that had caused such businesses to be such undervalued acquisition targets in the first place, and their descent put the lie to the claim that diversification allowed them to ride out a downturn. A major sell-off of conglomerate shares ensued. To keep going, many conglomerates were forced to shed the new businesses they had recently purchased. And by the mid-1970s, most conglomerates had been reduced to shells. The conglomerate fad was subsequently replaced by newer ideas like focusing on a company's core competency. In other cases, Conglomerates are formed for genuine interests of diversification rather than manipulation of paper. Return on investment. Companies with this orientation would only make acquisitions or start new branches in other sectors when they believed this would increase profitability or stability by sharing risks. Flush with cash during the 1980s. General Electric also moved into financing and financial services, which in 2005 accounted for about 45% of the company's net earnings. GE formerly owned a minority interest in N.